As we said, Phil Camporeale is here, portfolio manager for JPMorgan Asset Management. Maybe it's just the fact that we're close to mid-year. Yep. There's going to be second-half playbooks, but there is a market going on right now.
Yeah, and Carl, we're talking to clients about the market and the economy clearing hurdles. So what do I mean by that? So this is the first time, I'm so excited to be here today, because this is the first time that I can talk to you guys about, we don't think the Fed is going to move this meeting. Now, Sarah, I think you're right about it's not over yet, right? But at least in June, the probability is pretty low. I think they are going to pause. We're not going to misinterpret that as a dovish pivot. They're not going to want to get easing priced in. So it's nothing like that. But the Fed's probably not moving this meeting. The second hurdle is, just like the last 90 times in the past 60 years, we raised the debt ceiling. Okay, so clients worried about that and sitting on the sideline. And the third piece you mentioned, Carl, which is regional banks. I saw a great chart this morning. Fed expanded their balance sheet in early March to deal with all of those regional bank, calls. And that balance sheet has been completely back to where it was pre-March. So banks aren't tapping into these emergency facilities. And the point about vol, I think, is really important. VIX at 14, that's a really hard market to be underweight. Now, what makes it tricky is that mutual fund and ETF flows this year, $700 billion into money markets, $58 billion out of equity. So that creates really, I think, an opportunity cost. A well-diversified balanced portfolio, I'm not even talking about the NASDAQ or the S&P. Well-diversified balanced portfolio is up 7% this year. That 3-month T-bill is only giving you about 5%. So we've already gotten all of that return in the first part of this year. But what makes it really tricky is that we're still above the Fed's target on inflation. So we can't get too euphoric. It's not an overweight to stocks, but it's really hard to be underweight.
Right. Although there's a big dovish argument going on that base effects will give us maybe 4-handle, 3-handle, 2-handle in the next few months.
Yeah, Carl, the mother of all base effects is coming, right? Which is June of last year when inflation was at the year-over-year high. That month, inflation went up by 1.2%. That's going to be really hard to repeat. So I agree with you. Come this summer, we're going to be low 3s maybe on year-over-year CPI. But, Carl, that's still far from victory. And there's no Fed that wants to be remembered like Arthur Burns was, which is letting this thing kind of reaccelerate.
But you're underweight stocks.
Well, we're neutral stocks.
But you have been underweight, haven't you?
We were neutral stocks. We brought that to neutral in the beginning of this year, Sarah, basically because we believe that the Fed's terminal rate was finally within sight, between 5 and 5.5. So we're neutral there. Fixed income still looks like a really nice hedge because if we're wrong about this narrative, our soft landing narrative, Sarah, I think that the fixed income can really perform. But I can't stress enough how many people are in cash thinking that that's a 5% risk-free rate. While I guess technically that's true, the opportunity cost is rising when you clear those hurdles, Carl, that we spoke about earlier.
I saw the yen in there. Is Japan the most exciting story going on right now? I mean, given what the consumer there would have to do to keep pace with a new inflation picture.
Yeah, and Carl, I think this is the first time that we could talk about, I don't know, since I've been alive, about Japan having some sort of inflationary backdrop. And I think that creates a really exciting opportunity for non-U.S. investing, which has been so maligned over the past decade. Europe, same sort of thing. European Central Bank is in positive territory. I haven't been able to talk to clients about a positive policy rate in Europe since 2011, right? So all of this stuff, I think, is an exciting backdrop.
So what would it take to get you to overweight stocks? Because you sound pretty excited right now.
Yeah, well, I'm always excited, Sarah. So it's kind of this story of inflation really going back to that 2% target, Sarah, without a growth consequence. And we're not as euphoric to say that. We still have below trend growth in the U.S. We're not expecting earnings to pick up. But again, the story of the soft landing, which is inflation, disinflation continuing to occur and allowing the Fed to at least be on hold, is really important. But do not price in an ease. We are not pricing in an ease anytime this year. We'll save that for next year.
Last thing, really quick. Are you surprised at the potential for policy mistakes where we've not gotten one? Whether that's debt ceiling, Fed so far, ECB. I mean, it seems like we might have tripped in another universe at this point.
Yeah. So, I was comparing the U.S. economy to the Miami Heat. Like every time you think they're going to lose, they win, right? So I think, and the unemployment rate would be Jimmy Butler. So I think it goes back to the labor market, Carl. That has been, for us, a really important signal in all of this, that you've gotten wage inflation to move lower without really a meaningful jump in the unemployment rate, which is a real sweet spot. So without that, without there being a real correction in the labor market, no policy error in sight.
Yeah. It is really the cure that it addresses all ills, that's for sure. Phil, thanks. Great to see you.